as the economy continues to heal from the pandemic. And as we head into 2022, there's three big forces that are going on that I think we have to think about a little differently. The first is the shift that policymakers are going through right now with their priorities. And what you're starting to see in a lot of developed markets is much bigger emphasis on climate. In Europe, you're starting to see more emphasis on stimulus, and they're staying a little bit longer with their monetary and fiscal support. They're moving away from the austerity approach that they had. I think in the emerging markets, we're seeing some real challenges for policymakers there. There's a big move of populist movement right now as so many people are being left behind. I think the health care systems problems, as well as their dollar debts, are creating some big challenges there that creates a rethink of policy. And you saw that, with Chile.
Stephen, sorry,
yes.
Stephen, do you mean to be showing some slides?
I have one up. Is it not showing?
You have the cover slide.
Cover slide, yeah, I'm getting into it, Mark.
Okay, cool. Yep, yeah, go.
The second big issue is the policy response has really done a good job of strengthening household and corporate balance sheets around the world. So I think that's going to play out as the big shift that we see going on, the handoff from government to household and corporate balance sheets and corporations to drive the economy forward is an important handoff we have going on. And the other thing that came out of the pandemic and it continues is the accelerated innovation that we've seen. So we've ended up with a far better economic outlook than the headlines would lead us to believe. And while there's still a lot of problems with the variants, supply chain issues, demographic issues, political dysfunction, and geopolitical issues, we think there's a nice setup for continued strong returns in the markets next year and for risk assets overall. So it was interesting, Mark. I went back and looked at what we said at the end of last year. So this is the considerations for what would matter for this year from our December 28th briefing last year.
All right.
And we covered these issues, and there a lot of the stuff that we're still dealing with. Vaccine effectiveness was very mixed. The U.S. vaccines from Pfizer, Moderna, and other developed markets vaccines tended to be better, but the Chinese vaccine and some of the others did not. And how that played out is actually, who you aligned with was really a key element of that. We left a lot of countries behind as leading nations. We didn't do our part there, but we still are going through this massive global stimulus, working through the system, and that'll be with us for a couple more years, quite frankly. And if you look at the US, even if we start to taper, we're not tightening, we're still putting more money into the system, and we're keeping rates highly accommodative. Earnings were a great element for the markets this year and will be a key element going into next year. We finally passed an infrastructure bill, but whether it's enough or gets spent fast enough is going to be an issue. The cash came in off the sidelines, helped drive the markets up, but the regulatory environment for businesses globally has gotten more difficult, and particularly for the big tech players, but also for Chinese companies. And then we were wondering how the growth to value rotation played out, and that was kind of mixed as there were winners on both sides. So that's where we came into the year thinking. Now looking back, the big stories of the year, when we started off, we had the riots in Washington on the Hill. We had meme mania and a blow up of a hedge fund that cost a lot of banks billions of dollars. But through it all, the stock market made 68 record highs. We'll get into the dispersion there. Cryptos rallied and attracted greater interest, particularly from institutions starting to go in. The IPO market went wild for a record year. A lot of that was driven by SPACs, which had mixed results. The China process of managing down their excesses is one that is really fascinating, and one we think is going to be a key element of how people think about the world next year. We're comfortable that they're being very targeted in how they're dealing with their issues. They're targeting easing, and they're really focused on expanding regulation to take out excesses. We think that over the long term will be good. There'll be some bumps like we had last year. And then the other issue that was really the big issue is the political dysfunction around the world, and also the geopolitical issues. So just taking a look at some of these, the GameStop action was from our briefing on February 2nd. GameStop today is around 152 in price. So while a lot of people made money on the ride up, a lot of that might have been wiped out depending on which side of the trade you're on. But that kind of came and went as a phase. And I think we'll see kind of irregular price actions like that again. But I think the regulators are starting to focus on some of the issues that are driving that. But the S&P continues to hit new highs. And this is really fascinating. This goes back to 17. And you can see really how dramatic the move was. And Ed Yardeni is talking about 5,200 for the S&P for next year. So that would be about an 8% increase, which would be a historic average in line with the historic average, but coming off massive years of back-to-back returns, that would be a really nice outcome. But inside the market, there's a lot of things going on, and you really need to look deeper. And JP Morgan just produced a report that said if you looked at outside of the top 10 stocks, their drawdowns and multiple re-ratings have been pretty severe. And just to give you a sense, you can see in the Russell 3000 was only down 4% from its 12-month highs, but the average drawdown in stocks is 28%. So there is a lot of dispersion inside the indices that are creating opportunities for investors to win next year. Similarly with the NASDAQ and look at Kathy Wood's funds, the ETFs and the drawdowns they've had. I think she's right. There are opportunities for the upside, but not all stocks are going to win in that environment. So as we move forward, China managing their economy down, I think is a key element of what's going to drive the economy forward. There is a subtle handoff going on that's occurred over the last year from China, which had been the big driver for growth coming out of the financial crisis around the world, is now starting to hand that back to the US. And we think that's an interesting dynamic shift that may take some of the excesses out of the global economy and actually help the US economy, because we'll be importing with a stronger dollar, lower inflation coming out of that as China slows and their demand for commodities starts to ease. So as we think about going forward, the themes for us, the secular investing is the way to go in this environment. There's going to be a lot of head fakes through policy changes. So we continue to focus on the areas that are going to matter going forward, and that's tech and innovation driving productivity improvements against a world where there are rising costs in some areas, particularly in labor, and we have labor market issues that's going to drive a lot more move towards robotics and the like. I don't know if you've seen in the fast food industry, they're actually starting to really ramp up bringing in technology to replace staff. And you're going to see that to deal with the issue of unskilled labor and how we're going to deal with that. And a group of students from MIT have come up with an automated production line for salads and the like that basically takes kind of the Chipotle concept and uses machines instead of people to do it. And I think you're going to see more and more of those kind of productivity improvements that's going to help deal with some of the labor problems that we're going to have. We still are very positive on cloud and data management. We think the data needs of the world are going to continue to grow exponentially. Obviously, EVs are a big part of the future. We think defense companies in an unstable world are going to really matter. We think that the issues in whether it's the Middle East, Taiwan, or in Europe and with the Ukraine are real, and they're going to be very unstable for the next bit of time. We think the commodities and materials companies, and particularly in the spaces that are going to drive that are essential for the technology for electrification and digitalization, are going to be in rare supply. A lot of them are in jurisdictions that you want to see alternatives for. That's why we like companies like MP Materials and Cleveland Cliffs or Cliffs Natural Resources now. We like those types of companies in this environment. We still think biotech is going to be a big issue going forward. We think you have to play both renewable and fossil fuel to deal with the energy transition. You can't just rely on one. Mandates may have you do that if you're focused solely on an ESG mandate, but we just think the transition is going to take longer, and fossil fuels will be a bigger part of that as we go forward. Cybersecurity is not becoming less of an issue, it's becoming more. And we think there's some interesting dynamics with the cable companies that are going to, in 5G, that are going to give them more revenue opportunities moving forward. So as we think about the world, corporate profits are continuing to rise. This is a fascinating chart going back to the 40s. And you can see in the grade shaded areas, the different recessions we've had. But look at the dramatic move up from 2010 forward in terms of how sharp and quickly we've moved up, with stimulus coming from both monetary and fiscal support, really driving the economy forward. But I would also say the shift towards innovation and technology becoming a much bigger part of our companies, of our economy, is driving up profits considerably. So investing forward, we think that the U.S. economy will continue to attract capital from the rest of the world. Joe asked me about in the chat about Turkey, and do we think there's some problems? I think there are real issues in the emerging economies that their strains are going to be the benefit to the U.S. Unfortunately, that doesn't work on a sustained basis. But if you're investing, thinking about the next 6 to 12 months, I think that's how you want to think about that. We think the U.S. will be very strong for the next couple of years. We expect volatility will continue to be high. We like staying long equities as long as we're going to continue to have an accommodative environment, which we think we will have for some period of time. And when you look back at past rate cycles where the Fed is making a transition, it's not the early ones that create problems in the markets. It's the end of the cycle, end of the tightening cycle that does that. And we think we're a ways off from that. We also are contrarians in that we do believe that inflation pressures will begin to abate meaningfully in the second half of next year. We think they're already starting to in some areas. This latest variant will set us back a little bit in that area, but we do think the easing is going to come. And part of that is going to come from the transition of consumption from goods to services that are going to take some of the pressures off, and the pull forward that has already occurred. We think there are big valuation opportunities, and that chart numbers that I showed you about the drawdowns inside indices are where the opportunities are. So you're going to have to go below the headlines to see where the opportunities can be. There are some really attractive companies that are selling at deeply discounted prices off of their highs that will give people an opportunity to get back in. Small and mid-cap stocks are much cheaper than large caps, and historically so. And some important tech stocks have really gotten hit hard, as Cathie Wood's fund and others have seen liquidations. We think the hedge funds got ahead of their withdrawals when they had a good year. They were locking in their profits, and we think that's created some selling, and that's why you're starting to see the year end be more positive. That 68 number that I gave you for new highs is actually now 69 after yesterday, and could be 70 after today. So we continue to see that continuing to be a driver. There aren't a lot of opportunities for investment when the 10-year Treasury is selling for less than the yield on the S&P. And if you're looking at a high quality dividend portfolio, you can pick up 40 or 50 basis points over the 10-year Treasury with upside on the equity. We think that's going to be attractive still for investors. You have to look behind the headlines. Everyone is focused with the media on the near-term scary news instead of what is going to really drive the economy going forward, which are the secular drivers. And we think that it was really this handoff to consumers and corporations with their needs and their much stronger balance sheets. And with consumer net worth at record levels and continuing to move up considerably, we think this sets up very well for people to make a lot of money as we head into next year. It won't be easy. It'll be very bouncy, but you'll get scared out of your convictions at times if you're not really clear on what you're investing in. But for us, we think this is going to continue to be a good environment, although not quite as good likely as the last 2 years with 20+ returns. So I'll stop there, Mark. Open it up.
Oh, I was a little nostalgic looking at GameStop, and I remember those discussions.
And it was going to change the market, and it really didn't. Yeah.
But I have to say, if we look back in those recordings too, because it's all recorded. Yeah, you starting in March 2020 when it was even tougher, you had to make calls, and I think you made so many great calls. I can't remember exactly, but if I watched that recording, I think you were a cooler head. There were some that just thought that this is going to be a democratic populist fight against the hedge fund shorts. And
that was we've had manias before. It's just Wall Street, they just changed the stripes on them. Whether it was the portfolio insurance that nearly took the markets down, and all the different things we've done over the years. And people forget Wall Street's better at creating product than they are delivering on them in many cases. And I think, and now that it's not always Wall Street, the guys who created SPACs have created some interesting tax opportunities for investors over the last year with some of the returns on different SPACs. So it's going to be interesting to see how this all plays out. But I think was kind of the normal ebbs and flows that you have coming out of a severely depressed economy. And as soon as the Fed stepped in, it made it a lot easier to make your calls. So.
Hey, Steve, it's Robbie. We were just talking a little earlier. I wanted your quick thoughts on the holidays. Are interesting times to reflect. You catch up, and one of the things that you see when you're sort of back, just catching up, either doing year-end wind-up or beginning of year planning, where inflation really took toll. Meaning simple things where you prepare holiday meals, and the price of meat was let's say a third more. But then I had to replace a battery in one of the cars. And my God, the last time I bought a battery in this car, it was like half the price. It was like double the price. I wasn't sure that was EV driven. But so just quick thoughts from you on the either inflation or cost expense side. But then also on this Omicron, I think we all have the benefit of 360 of being able to participate effectively virtually. But then I think it's thrown a curveball for a lot of these like large gatherings that have had to either cancel or wait. I think I saw JP Morgan Healthcare, which I was planning to go to in January in San Francisco, went virtual. So as a result, a lot of the side events are going to get either canceled or like. So I was just curious as the Omicron and what are your the mindset thoughts there?
I'll do them in reverse. Then I'll start with Omicron, because I almost forgot the first part of the question and then wrote it down. So, on Omicron, I think we're getting to a point where Bill and Glenn Grossman have been right that we're pushing towards herd immunity, whether we like it or not, and that it has created some short-term disruptions, but I think it just helps us get to the other side faster and move us to an endemic. I'm not sure if we have a couple more variants that pop up, whether I would feel comfortable with that statement that I just made, but it feels like we're moving closer to the end than the middle of the variant. And I think will allow us to move back to more normal. And if you think about that, as we move back to more normal, a lot of the issues that are creating the inflation will ease as well. So I think that's one element, that getting to the other side without the fits and starts. And I don't think the lockdowns will take, certainly not in the United States and some other countries right now with the Omicron. So I think we're going to learn to live with things better. So I think that's what's going to happen there. It'll be interesting to see if the numbers hold up. It looks like the US is probably a couple weeks away from peak if the projections are right. And if that's the case, then that would set up for a pretty strong year next year for a lot of things, economy and markets. I think that also leads to an easing of inflation, because as you open up things, we'll be converting from spending from goods to services, and you'll be going back to the things that we haven't been spending on. That'll take some of the inflationary pressures off when everyone was chasing the same, I need a computer, I need this, I need the lamps and all the stuff we did to work from home. I think that's going to start shifting, and you'll start to see those things easing. And when you combine that with the fact that in the US, the dollar is rising. So for US inflation, we think is going to ease because of the strength of the dollar. We're then for importing deflation rather than inflation with that. And we are still big consumers and big importers. So that does help. Natural gas prices are coming down. We think oil prices will still be elevated, but even there, they're off their highs a little bit. So not having them continue to go up from an inflation number perspective means that we may have higher prices, but not higher inflation in subsequent years. So for us, we think the deflationary tendencies of the economy are going to start rearing their heads again. That's the debt issues. That's going to create big problems for emerging market economies. And I think the difference between the US and the rest of the world is actually going to be even bigger. But I think the emerging market economies are going to see inflation and they're going to have some real issues. I think it makes it more difficult to invest in their public markets. I think investing in private investments anywhere is you're making the same bets that you would make, whether almost regardless of jurisdiction. If it's a good idea, it's going to work. If it's not, it's not. And I think you can be more global in terms of private investing. I think public market investing is going to be a little bit tougher. And I think that's going to lead towards more developed markets doing better next year. I think there are real issues, though, and Joe raised this issue earlier of Turkey and what's going on there. And I just think there are some real problems in the emerging market economies. There are real problems in the Middle East. A lot of that goes back to the healthcare problems that they have. And until they can get their health issues squared away, get vaccinated and all that, and you're going to have problems getting their economies going, and that's going to create even more problems for them politically. And I think that you get the snowball effect. It's going to be hard for them to get out of some of the challenges that they have. I think Chile is going to be a very important country to see how they make the transition. It was raised last week by somebody on the call that I think Angela was saying she's optimistic about that election. I think you can be optimistic because the guy was somewhat pragmatic in his recent remarks about transitioning and keeping some of the good parts of the economy while still trying to get some of the populist and inequality issues addressed. So I think we're going to have some challenges, but I think for the US, I think this is a good time to invest. And I think for private investing, you just have to pick the themes and make sure you got the right due diligence regardless of the region. Does that help, Rob?
It's very good. Thanks.
You lived up to your award, Rob, for the first question. I think Adam wanted to ask it, but he was deferring out of respect.
Well, there was like a 10-second pause there, so someone had to break the ice.
Pregnant
Good,
pause.
Adam.
Yeah.
The fix is in.
Hey, Stephen, this is Dave Kroom. When you refer to
Who else has a question? Comment.
Dave Kroom.
Dave's here.
Mark.
Hey,
Yep.
when you mentioned the conversion and maybe the relief of pressure of inflation from demand of hard goods to beginning to spend that household income on services, what do you think the fastest turnaround? I mean, being 2 years, and sadly for me being a restaurant owner and a gym owner, it's challenging. The restaurants have come back, but the staffing is a forever challenge because people have left the hospitality industry. And on the gym side, it's really, on life support. I mean, people need to go back and get back to their routines, but I think it starts with going back to the office and home, work, gym, that routine, and it's just not there, at least not in Seattle.
Yeah, I think you're right. I think that, there's some areas that are just going to be way behind on the recovery because the people don't want to do that right now until they feel safer. But I think there's another issue, Dave, that the U.S. has to deal with. And I don't, somebody on the call would know the statistics better, but we're over retailed to begin with in our country by a wide, by a multiple of what other nations are in terms of our retail stores. And I think maybe we got too far along in that. And we don't have the need for all this kind of businesses we created. So I think that's going to be some kind of washout that we have to kind of right size a lot of what's going on in the retail sector. So I think that's going to have problems. I think the travel and leisure stuff is just going to really depend on, are we right that Omicron is turning the tide and that we'll get to herd immunity? Otherwise, a future variant will set them back longer. And I think that will be the death knell, because I'm not sure that the desire to carry businesses is going to be that great from politicians in this environment. And that's going to, I think, put more pressure on bigger companies, because as their profits are going up and their earnings are going up, the populist movements are going to target them and look for them to do more. And that's where the social tension is going to come in. And so I think we need a healthier economy that's better balanced, but there's going to be some carnage still to come.
Yeah, David, I would add, I think the pent up demand for services like restaurants that'll come flooding back. People are dying to get out, and I think that'll come from. I think on the you talked about the gym front. I think, technology has allowed for this, community remotely in gyms. You think of the Pelotons of the world and others. And, I have a wife who's a yoga instructor, and that can now be done virtually, and you get a gathering and people get that sort of social interaction. So I think, to Stephen's point, I think that one might be a little bit slower, but I think things like restaurant, I think that pent up demand comes roaring back as soon as people feel safe.
The other thing that's interesting about the restaurant area is what you're seeing in terms of automation to deal with the lack of staff and how fast that's going to come. And I think that the companies that win are going to be the ones that make the big productivity investments and can afford to make the productivity investments. And I think, Dave, to your issue, a lot of these guys have had 2 years of real financial hardship, devastation even, and they won't be able to afford to do that, but some new competitors will. And I think we're going to have that kind of, unfortunately, that kind of creative destruction that has gone on.
Steve, is automation in the restaurant industry, is it more targeted like the burger joints and stuff, or is it sort of broader than that?
I think it's starting with the fast food stuff, the stuff that you're paying kids, very little to do and having trouble getting to show up. I think what they can do now, what they're already starting to do, is really going to automate that industry considerably. I think it is a different issue on the, I don't think you're going to go to La Bernardine and expect a robot to deliver your meal just yet. So,
okay.
But, Sean, I would just give a little bit of healthy pushback. I saw Mick's comment here that he did exactly 0 yoga classes in 2 years. I think the gyms, particularly gyms that have some of the cafes and some of the social interaction, kind of the argument on restaurants, those gyms are, I think, are going to be kind of sought after. And because they're going to have more motivation when you work out with people live. And you mentioned Peloton. I think Peloton's experiencing, some of the softness as far as people wanting to, have that isolation.
I don't disagree, Rob, but I do think you're going to lose some. I think there'll definitely be some people who are that you've lost because they enjoy the experience remotely and they'd rather do it for the convenience of their home or what have you. So I do think there'll be some pairing of gym membership that is now comfortable doing it remotely.
And I'm not sure of the margins, Rob, but I think the issue that some of these retailers are facing is if their margins are that thin and you lose 10% of your audience.
It's over. Yeah,
over.
That's all it is.
And that's all it takes. So these shifts don't need to be that major. They can be subtle and be devastating at the same time. Richard, I think has a hand up.
Yeah, I was just going to make a quick remark. My father is the chairman of the Council of International Restaurant Brokers. He deals with global restaurants moving country to country. And one of the things that he had remarked on is that, clearly there's a disparity between fast casual and slow food. And the slow food people carry so much additional debt as that debt is trying to be refinanced and rates are going up with expectation. That's one issue. But the other is that many of the restaurants over the past 15 years, the number of people eating at restaurants has grown by about 50%. But the number of restaurant seats has grown by like 120%. So you have more restaurants competing for fewer seats. So while the population's increased, the restaurant space has. So there is plenty of room for convergence in that area. And some of those that have carried debt for a long time, this is an excuse for them to either close doors or merge or sell or restructure or something. There's also a friend of mine who's a former CEO of a group called Panera, of Noodles. Noodles has had 10 of the last 12 years negative NOI. Not just the past 2, but 10 of the past 12, partly due to that tightness in the fast casual space. So I think there's going to be some consolidation in those areas, and how much falls out. I guess the point of it is, as an investor, there's both, for me, short opportunities, and there's an opportunity to go buy those that are going to pick up those additional seats. And to your earlier point, and I think some of the other folks, those that have higher levels of efficiency and are able to maintain higher margins are going to see exemplary growth. I don't think it's going to be a system-wide. I think you have to pick which ones are going to be your winners and which ones are going to be losers, I guess is the point. But anyway, thank you.
It's great information. And I think selectivity is going to be one of the key themes for next year, because when you see below the surface, like we showed with how big the drawdowns were for so much of the NASDAQ and the S&P and in the Russell 3, you can see that there are select pockets of opportunities, but all those drawdowns, some of them are well earned and won't rebound into the new year. So, Dave, did you have something to add?
No, I think, well, my only recommendation to everybody that has a neighborhood gym, even if you don't want to go, is get your ass back in the gym and pay the dues nationwide.
Spoken like a gym. That's spoken like a gym owner.
A little self-promotion there, Dad.
Yeah,
Nice
no,
one,
we'll figure.
Dave.
Yeah, we'll figure it out. We've survived this far, but
Hey, David,
more
and
challenges.
Erica, I got to figure out if we're going to add Seattle to the West Coast tour. It's every day in every city is tough, to get everybody for a whole week. But maybe you guys can help me push me over the edge.
Yeah, I think the focus should be on LA.
Definitely Seattle.
In Seattle, there can be a stop. I mean, there's lots going on here, so it's up to you guys. I think if you rush it too much, trying to get over the border, if you're going to come from BC,
We're not going to do.
that's going
we're
to
not
have challenges.
Yeah, I think, yeah. But we'll talk about that separately.
Okay.
Yeah. Well, and Mark and Dave, it's Angela here. Mark, just so you know, I just sent you a message, but it's Dave that kindly has suggested taking the sports event as a possibility for a venue to the LA Athletic Club, but he needs some details. So check your emails. But Dave, thanks for that offer to take it to the LA Athletic Club, and let us know if that works. But I'll get back to you once I hear back from Mark and Charles and Jack on whether that's a venue of interest.
I've done an event there, so it's a great
Perfect.
space.
Okay, perfect.
Stephen, I've got a question regarding the Turkish situation. Is that an isolated situation? That's the first question. Second question, obviously it's something that something you wouldn't want to do. They're not managing the economy. Do you see that happening in other emerging markets?
I think the issue with Turkey is multiple issues, but it starts with you have an autocratic
Right.
Guy who doesn't care about too much of anything else going on there other than what he wants, and it's so unusual to have runaway inflation and be lowering rates that it defies any kind of logic. So I think that situation is very unique to Turkey, because I'm not fully clear on what he's actually trying to accomplish with his approach there. It's baffling, other than trying to prove he's going to be right regardless of what the laws of economics say. I do think that there are different issues in each emerging market that are going to be specific to that country, and what their basis for their economy is going to really determine it, and their debt loads. They have a big population, but they have a lot of inequality, and that's creating even greater populist movements, which makes it hard for them to take advantage of the institutions that can drive their economies forward. I think there are leadership issues all over, and I think that's going to continue to weigh on a lot of those economies. The other thing is that the health issues are really one of the biggest ones for them, because you get an unvaccinated population with this variant, and it's going to blow through there, and they're going to be overwhelmed. So hopefully, on one hand, you get to herd immunity. Hopefully, the damage to getting there for those economies is not so great that they can't recover. And I think there's that for us, one of the big issues we're worried about is failed states picking up because of the strains, and that will create migration crisis that, I think just the other day, 12 people were trying to escape the Middle East to get to Europe, were found floating up on the shore dead of Libya, and we're going to see more. There's those, that issue of migration is a big issue, and I think it's going to be not only a social but political issue next year that's going to create some real strains in Europe. I think that's going to continue to go. Go ahead, Rob.
I had a quick thought, and maybe this is an Adam quick question. I was with a former U.S. ambassador to Europe, and he brought up Ukraine more than I thought with respect to some of the Russia threat there. Adam, do you or Steve have a quick input on that? And we have some presence in Eastern Europe in manufacturing in Hungary and Poland.
Adam, you can go first.
I don't believe that Putin's really going to go into Ukraine. He can't afford it. Although there are a lot of arguments saying that, look, he's a 69-year-old man. There's a lot of pressure. His best years, quote, and I put that in quote, in terms of economic development are behind him. You're looking at a country where hydrocarbons are going to become less important in the future. It'll take time. But moving into Ukraine, rolling through Ukraine, I don't see that happening. It would, the two issues there. You would have an uprising in the population when those body bags come back home, because these are common Russian people from the provinces that are in the army. The Ukrainians are going to fight very hard. Putin has done more to unify Ukraine than anyone by taking Crimea and also Donbass and that entire region. I think the demands that have been presented are rather typical of Soviet era demands. And keep in mind, he's more of a Soviet minded individual in his training as a KGB agent. I don't believe he expects any of those demands to be met. And it's a negotiating position.
You think it's negotiating for the Nord 2? Or more than that?
I think it's larger than that. I think his mindset, and look, I don't claim to know what he thinks. Nobody knows what he thinks. But there is a lot of emotion built in him, the humiliation of what Russia went through in the 90s. That's very much in his head. And he has also Patrushev, who's the head of the Security Council. If you ever read his writings, those are really off the wall. That's a paranoid, the West is out to destroy Russia. The end of the empire, where, I mean, the difference between Imperial Russia and Soviet Russia, there really wasn't much of a difference. Yeah. When the Soviet Empire, when the Soviet Union collapsed, that was the end of the empire. So I don't know, but it is a danger.
You have a lot of things behind you that represent that era.
Where?
Russian, Soviet.
Oh, I didn't realize that those could be seen so well. I'll change them.
Yeah, I forgot, Mark. You also have, you have some, you and Simon have some defined knowledge of the region. So I'm sorry for.
No, I defer to them.
Well, Simon would give you he would go back to the 800s where it all started. Kiev route.
We can read the book he wrote about it.
Which is an interesting point, that the Orthodox Church really started in Kiev. That's sort of they always say that all roads lead to Rome. They call the Tretí Rim, the third Rome, Kiev. So there's a lot of cultural nuance here that probably we're not all appreciating.
Yeah, and that, and losing your sphere of influence.
Yeah,
Not only Ukraine, but the Caucasus in Central Asia. And the pretext of, okay, well, here's our demands. You've not met any of those demands. Okay, we'll start negotiations January 10th. From what I understand, negotiations begin January 10th. The best thing that could be done is draw those out as long as possible. If he does go in, it would be into the Donbass area, but certainly not all the way to Kiev and taking all of Ukraine. That would be doubling down in a big way.
Well,
That would be very,
maybe
and then
maybe
on
we'll-
top of that, sorry, Mark, one more piece of that. If he does go into Ukraine, he also has Belarus. And for many years, he's been wanting to bring Belarus into a union. And he's got issues with Lukashenko. Remember, there are troops in Belarus as well, Russian troops on the border with Ukraine in Belarus.
Hey, Adam, why don't you, could you put together 2 or 3 people that could have a perspective on this, have a little deep dive on maybe next week on what's happening on the Ukraine-Russia relationship?
Next week, possibly.
Well,
I'll
2
get
weeks,
back.
whatever, but the soon, while it's a pressing issue.
Well,
No, it
you know, one of the, I mean, Adam, your inputs is interesting and actually comforting. The fact that you feel that there isn't going to be that type of invasion.
Well,
But I think the
Rob,
larger
to that
point here,
I think there are counterpoints to that, because
Yep. No, but the other thing
the
is-
reason you go 200 kilometers is you take half of their GDP, right? You have pipeline control. There's
biggest part of the industrial part of Ukraine is
it's right
in
there.
the east.
It's right on
Yeah.
across the border. So there are reasons to go across the border 200 kilometers. I don't know what you're gonna increase your GDP by 25%.
And,
yeah, but the point of sanctions and other things are meaty, and I kind of brought this up because back to, funny enough, Joe's original question to Steve on Turkey. These emerging markets are very linked, and you know what happens in Eastern Europe with the emerging markets affect things like Southeast Asia and Latin America and Africa.
Yes.
And you know, I think just for what I've seen, just some of the talk here on the demands on NATO, that Ukraine not join NATO, that was never on the table. But I think, you know, Russia was putting that on the table. But you know, it's just interesting because Steve, to your point, going back to the economics, you know, there's you know, there are both policy and real economics that affect these emerging markets on a basket basis versus this being strictly Turkey. And frankly, if you get really deeper into it, I think Turkey's been known to, you know, have relationships with sort of multiple sides. So I'll leave it at that.
Yeah,
Yeah,
there's
I
a
do think
huge.
though, Rob, I would just say from the early stages of the BRICS to now, there are a lot of the emerging markets are less homogeneous, and I think their issues have evolved to be very country specific. So I think there are big interdependencies, but you actually have to take each one on its own, because just look at the BRICS and the divergences that they've had in economic fortunes from when that started. And then you go to what Jim O'Neill called the next 11, and they have massive divergences as well in terms of what works and what doesn't. So I think that's going to continue to be an issue that
Yeah,
you
I
have to
think
look at
there's
it a little differently. Sorry, Jeff.
Yeah, but I think to Rob's point, there's a lot of intricacies that you don't really know until it gets unwound. Like there's a big yen Turkish lira carry trade, right? That the retail investors in Japan have been one way like for years, because they've just been like, you know, high interest rates in Turkey. Okay, I'll, you know, sell yen rates. But now that Turkey's looking to blow up, like all these retail investors are finally realizing, oh, we're all one way, and now we probably should not be that one way. So, you know, that's just a small point in the greater kind of macroeconomic picture, but you know, it has knock-on effects.
Yeah, I think you got to be really, you always have to be careful investing in emerging markets. I think this next period is going to be really tricky. The monetary policies are going very different directions. Now that the US is tightening, they've been tightening for a while. I think the strength of the dollar is creating some strains on their dollar debts. So I think the highly dollar indebted countries are going to have some big problems. But the other thing that's gone on in the last couple of years is their reliance on China for the Belt and Road. And the results of that have been, for a lot of countries, less than satisfactory. And they're going to end up with either higher debts just to a different country or losing key assets like strategic ports and airports and things like that. So I think there's a lot of stuff under the surface that you really have to look through.
Other comments, questions?
Yeah, Mark, where are you, by the way? Speaking of cultural music.
Central America.
Rob will be there in about 15 minutes.
Yeah. You're right.
So
next
you're-
door, probably. You're in the hotel. next
Costa
door.
Rica by the look of that face mask.
Yeah.
Okay.
That's right.
So you're not going to the Michigan Georgia game, it sounds like.
Well, theoretically, it's possible, but I'm going to go to the Michigan Alabama game in Indianapolis.
I'll see you there, Mark.
We'll have a.
Oh my goodness,
We'll have
all the M's coming out.
Another fanatic.
361 and Michigan Connecting will have an event on the 9th, that Sunday.
I think I saw Georgia as like a 7.5 point favorite, but I'm rooting for Harbaugh. I'd love to see you guys get to the finals.
Well, I think Alabama was a 10-point favorite when Ohio State won. So we'll see. And I would say that Michigan is trending up. I'm not sure about Georgia.
I'll just say this, Rob, that, the matchups are pretty good, and most folks on the Michigan side are pretty confident. Like, I've never seen them before. Now, if that ages well, we'll see.
That's because we haven't been here before in a long time. So it's
Right.
just
Well, being a Georgia guy, I was pretty confident before the Alabama game, but now I'd probably bet on Michigan as well. Just as an
We'll see.
aside. Yeah, you got some points available to you, so 7.5, I
Yeah.
bet.
take the points too, Richard. You never know.
Right.
Hey, Mark, I just want to thank you and the 361 community for coming on every week and engaging in these discussions. It's much appreciated, and I'm happy to be a part of the community. And thank you guys for the support, and look forward to a great 2022 and to getting back on the road and getting past the pandemic. So thank you all.
You're the one we should be thanking, though.
Yeah,
You're
I was
the-
going to
You
say
do
that.
regularly, Mark.
I agree. Yeah. Fantastic.
I get reports from all over the world. I get reports from all over the world, and I pay for news reports from different groups on bonds and what have you. And I get more information and with more clarity in this period of time with you guys than any of those other resources. So yeah, thank you for all
Don't
that you
give
do.
them ideas.
Yeah,
Thank you, guys.
Mark, to Richard's point, and what Jack mentioned earlier, the culture. This is one of the few forums that we've been able to pivot, I think, well, both in person, hybrid, and then the virtual. And it's, I guess the good news is, you do it with regularity, but the cool part of it is, you've got some interesting minds that can kind of pivot to so many different areas. So keep doing. I'm just surprised you got to wear a mask outside where you are, Mark. So it's I guess it's a good thing.
I'm by
It's
food.
good.
They're very strict here. I have to say.
They are.
They only have one case of Omicron, at least as of when we came. High
They require you to
vaccination
be
rate.
vaccinated to come into the country, don't they?
They do. You have to have.
Yeah.
You have a QR code.
What
Yeah.
town are you in?
It's by Playa Panama on the west, on the Pacific coast.
On the Pacific Coast, yeah. I used to live in Manuel Antonio for years.
I'll post on the app the sunset.
It's
the
gorgeous.
whales,
Yeah.
the whales, the dolphins.
That's right.
Beautiful.
Their whales are coming up from the south.
Beautiful.
Yeah, Mark. I may have a relation to connect you with down there if you're going to be there for a few days. So I don't think I'm going to be there in person
Go
this
for it.
week, but it's
I love that you even like you sort of swaggered that you could. You know, I love
He's the
that.
only one that could say with the straight face, Mark.
And he's the only one who we would accept it with credibility.
Yeah, I posted on my LinkedIn. I actually got my booster shot yesterday. The bad news is the arm is feeling it, but I guess the good news is I'm doing my research. That means it's working. So it was the Moderna booster. So
I read. Well, I'm worried about schools closing. That's on one side, but I read that the efficacy is 30 to 40% against Omicron. These vaccines. I don't know with the booster or not, but we're going to see the silver lining is herd immunity.
well, I mean, you could have that all that herd immunity. I'm gonna put my money on technology and get and get it where I can. So I'm hedging against.
We should all do it. Yeah. We are doing it.
Oh.
It's just despite it.
Yeah, and actually, the strange football thing. If Tom Brady has a decent 1 or 2 games, that may actually, because Aaron Rodgers kind of fibbed about getting the booster or getting vaccinated, that may pivot towards the Brady getting the MVP. So we'll see more in the next few weeks. So
fair enough. We're gonna be doing a Super Bowl pre-Super Bowl, as Angela can attest. All right, I'm gonna go back because I have a 5-year-old who wants to go in a pool. So.
Running around the pools.
Well, thanks, Stephen. And thanks,
Happy
Mark.
New Year, everyone.
Thanks, everyone.
Bye, guys.
Happy holidays.
New Year,
Happy
guys.
New Year. Yeah, take care, everybody.